blue mark.
Yeah, I've got to stand on the blue mark. Okay. Hi everybody, hopefully if I speak loudly you'll be able to hear me at the back. My name's David Harris. I'll give you an update on what I presented last month. I'll say next to you all, and there's going to be a lot of them because that's the way of the graphics. So identifying a market top in the US market. Next. Okay. This is a chart of the Dow Jones over the last few years. So it's last year, this year, and 6 months of next year. And we're getting close to the top. If we compare the price where we are now, next, with the price at the end of last year, we haven't actually come too far. Next. It's only really 508 points. So this is quite typical of a market top when you have a narrow band happening across the whole year. There's a lot of buying and selling going on. The balance between wolves and bears, it happened in 2007, it happened in 2000. So that's indicative of the fact we're close to a top. Next. Moving forward, next. I got a signal in June that the market top was close. The signal is very reliable. It's happened 20 times over the last 130 years. And in each of those 20 times, there's been a market drop. This is the 21st time. I'm hoping it's true again. For the accuracy of the model, it may not be good for everyone because the market goes down, but in terms of the accuracy and credibility of the model. The model itself tells me that there's going to be a market drop and a top, but it's not very accurate in terms of when it's going to happen. It could be over the next few months between now and the end of the year. So what I did is I built a second tool which gives a little bit more accuracy. And next, if we go forward, the first window of opportunity was just passed, and that was the last 2 weeks of July. It looked like it created a top, as Darryl said. The market came down, but there were other key signals I would expect to see, and they did not happen at that point. So I was fairly confident that wasn't the top, and the top was going to happen later in the year. Next. The next window of opportunity is a 7-week window, and that's the 4 weeks of October and 3 weeks of November. And that's quite a likely top scenario, because going back through history, a lot of tops do happen in the October timeframe. Next. We also know that the Fed is ending its QE3 program at the end of October, and that would also be a possibility of downturn. We saw in 2011 and 2012, the market dropped once QE was stopped and the liquidity in the market changed. Next. The next window of opportunity is a 4-week window at the end of the year, and that's the last 2 weeks of December and the first 2 weeks of January. Next. And the final one is way off into spring and summer next year. That's quite a large window. I've only shown some of it. That goes into August next year. But that's so far off, I don't think that's going to be the top. The way I actually formed these windows was I took input from the Dow Jones, the S&P 500, the Russell 2000, the NASDAQ, and I took that data and created a hybrid probability density function which gives the likelihood that tops are going to happen in these time periods. So my bet is that we're going to see a top probably in October, although we might get a Santa rally and a spike up in December. Next. Right, so in terms of other algorithms I've built, I do get price projections calculated of where the market might get to, somewhere in the range of 17,250 to 17,300 is what I'm looking at the moment. It might go a little higher than that, but that's the projection at the moment, so we might see the market go up to that level, maybe a little bit above. So we're looking at the October time frame and around about that level. So that's an update on my presentation last month. The other thing I want to do now is answer a question that Darryl posed last month in August, and that is what happened in the 1990s when we had significant drops in the market in 97, 98, 99. So I'm going to give you a little bit of presentation, just a couple of slides about what happened, I think, during that time period. So next, it really started with the 1987 stock market crash. Next. This is a chart of the crash. It shows 1987, 88, 89, and it shows the severe downturn that happened in 1987. Next. There was a bubble building up through the last few years up until this point, so the mid to late 1980s. And a crash condition happened, and the model I built showed that this condition happened in the August of that time frame, and at that point the market became unstable and then started to crash. The bubble got to the point where it couldn't go any further, it came down. Now the interesting thing was the market at that time came back within 2 years of recovery. So you go back to 1929, in the Great Depression, it took something like 25 years for the market to come back up, which was a huge amount of time. And yet the market came up within 2 years. It was a big decline, a very frightening decline, but it came back up very, very quickly. One of the reasons why it did that was the Fed injected massive liquidity into the market at that time to boost the market up. And the Fed chairman at the time was a fledgling Alan Greenspan. He'd only been in the job a few weeks. Next. And what he did was he pumped lots of liquidity in the market and he saved the day. But what he actually did was, as well as saving the day, he stopped the bubble from deflating. That bubble continued to grow all the way through the end of the 80s into the 90s up to 2000. And I'll show you that on the next slide. Next. So here's a 20-year span from 87 to 2007. And next, if you look down the bottom left-hand corner, next, you see the crash now. There's a blip on that screen. That was a 30% drop in the marketplace. It's a huge drop. But now, looking back, it's actually quite small, but it's very significant at the time. Next, you'll also see the market top of 2000, where the bubble pretty much came to a top. And what happened when Alan Greenspan flooded the market with liquidity? He did not allow the bubble to deflate correctly. Next. that red line there shows the point at which the bubble really started to grow. And all bubbles, when they deflate and crash, they have to go back down to below the level they started growing. If they do not, they continue growing. And that's true of all bubbles. They have to come back to the point they started at. And because he flooded the market with liquidity, it kept growing. It kept going through the late 80s, into the 90s, all the way up to the year 2000. Now, you might ask the question, well, how can the market go back down below that level if it keeps growing? Well, the thing I worked out when I researched this is that line drifts over time. And my calculation was that red line starts to drift over time, and that's the line that defines whether the bubble's deflated or not. And so you can see all the way through the 90s, the market kept coming down, almost to that line, but then back up again as more liquidity was thrown into the market by the Fed. And it wasn't until 2001 and 2002 happened that finally that bubble of 15 years deflated. Next. And then it deflated down into the bottom of 2002, which we know was that low in the October of 2002. Next. So we have the crash condition in 1987, that red circle there. We had a recession in 90, a recession in 94, and then if we get to 1996 next, we have what was almost a crash condition, is what I call a panic. The market did hit the top, came down. I've got it in blue there. It wasn't quite a crash condition. But that was the start of a series of successions where the market kept hitting crash conditions before it got to the 2000 top. 1987 was the Asian currency crisis, and the central banks around the world, they injected liquidity into the markets to make sure that crash was dealt with. 1998 next. In 1998 was the Russian ruble crisis and also long-term capital management, which was a hedge fund that was very large and imploded because of the issues that were going on in the world at that time. And the Fed had to come in and inject liquidity into the market and again save the day. And then next, in 1999, there were also issues in South America with Ecuador and with Brazil and Argentina. And again, the market, with that red circle, hit a crash condition and started to come down again. But each time the market was injected with liquidity and kept going up. Interestingly enough, when the market finally reached the top in 2000, it wasn't actually a crash condition. It was actually a very weak top signal. It took me a while to design a way of spotting that top. But the actual top in January 2000 wasn't a crash condition. That the market had started to show weakness and then it started to come down. So what you end up seeing there was a 15-year bubble started in the mid-80s, and that tech bubble went all the way through the end of the 80s, through the 90s, and up to 2000. It wasn't deflated properly until 2002, and that was the final end. So hopefully that, in a couple of minutes, has answered the question that you asked them. So that's the end. Thanks very much for listening. That's an update. We're looking forward to October this year, and maybe early November, to see what happens next. So in the next presentation in October, we'll see whether we have got a top formed in October. I've got a newsletter I send out every month, so if any of you would like to be part of that, some of you came up last month and I've added you to the list. If any new people want to be part of the newsletter, I can add you to the list. And that goes out every month or two. So please come up at the intermission or at the end and I'll add you to the list. Thank you very much. Any questions that you'd like to ask?
Have you ever looked at the presidential cycle?
Yeah, that's the 4-year cycle, and we get weakness in the second year. I've looked at that. I don't incorporate that strongly into the model. However, I'm aware of it, and I always look out for that. I thought this year potentially could be weak for that reason, but there are other bigger things at play. So that presidential cycle comes into play often, but not always. If there are other things in play, then it's not necessarily as strong as it would normally.
I have a question.
Yeah.
Well, first of all, you're not saying about stock. What does that does stocks mean? Does it mean that you're supposed to buy or sell?
Well, a number of things you can do. If you're an aggressive trader, you might want to short the market. If you're somebody who's concerned about maintaining a portfolio, you might want to hedge, which means that you keep some of your portfolio long and short some of the market, so you balance out neutral. If you're concerned about the portfolio that you have, what you might want to go into cash and come out of the equity market, leave it for 6 months, wait for a bottom to happen, and then when the market bottom happens, you might want to then trade back in again. But that's something you'd want to discuss with your own personal broker or financial advisor.
Thank you.
Okay, Jack.
Does your model give any guidance as to how deep the market will drop after?
Yes, that's a good question. So, of the 20 times this has happened since 1885, which was 130 years ago when the Dow started, the smallest decline is 12% for these 20 signals that happened before. The largest one was 90%. That was 1929 during the Great Depression. And the second largest was just recently in 2007 to 2009, and that was about 55%. So we just saw the second worst decline recently, just in the last 5 years. On average, it's 30%. So I'm expecting somewhere between 12 and 30% to happen over the next probably 6 months to a year. The same thing like the last two downturns we had in 2000 2007. It could last a year or so.
Thank you.
Yep.
You mentioned that in July or June, not all the conditions were met. Which conditions were not there?
There are other models I've built which show rhythms in the market and signals that would happen, and they would normally happen within a few weeks to a month before a top. They were not there. Just other algorithms I've built that would normally signal something just before a top, and they weren't there. They're quite complex, so I don't want to necessarily go into it now, but I have a series of algorithms that trigger, and I back-tested them over many years and different market
You
targets.
can answer that very quick.
Yes.
Every one of your tops was caused by an event, currency crisis, something else that occurred the top to happen. You can't tell me. You don't know when or where because you don't know what Putin's going to do. You don't know what ISIS is going to do. You don't know an event that can cause a catastrophic drop in the market tomorrow.
Quite correct.
Tomorrow's 9/11.
Yeah.
Do you know what they have going to do for us or do to us or anything? There is a certain amount of unknown that I don't care what your model shows, it can't happen.
Well, Darryl will be going through that later on in his presentation. there are many, if you have a comment, you would peripheral vision. There's many things you are looking for as we go on, and I'll let Darryl cover those. This is more technical analysis, but I do look at all the fundamental analysis, I look at all the triggers. But you're right, it could be anything, we don't know. It could be a black swan that's going to hit us. If you read the news recently, an asteroid came very close to us on Sunday. I don't know if you read that. It came within some of the satellites that go around the planet Earth. It actually came within their satellite orbit. So anything could happen, you're right. But this is the mathematics behind price movement. And that actually is somewhat independent, I believe, of what's happening geographically. But in the end, instability in the market and bad news around the world join together to cause downturns.
Why did you leave the Dow Jones Industrial and not the S&P?
I actually do look at the S&P 500 and the Russell. I just, for some reason, because it's 30 stocks and not as big as some of the other ones, not as broad, I just have a fascination for it. I also have more data. I've got data back to 1885. I've got daily data back 130 years. I can back test my algorithms much further. The S&P 500 goes back less, about half of that, and then Russell and so on could go back much less. So it's really the massive data that I've got that I can back test.
That's it, one more
You
question.
have your money right now.
Okay.
Anticipating the stopping your trajectory.
Oh, once we get to the top, my one will be short.
No,
Okay.
where you.
I buy short ETF. What is it right now? Just sitting waiting.
One more question.
Okay, one more question.
Is this only backtesting or you want to prove it accurate?
Well, over the next few months, if I'm right, I'll be able to come to you in October, November and say, that was the top that I predicted. If I'm wrong, you've got to throw rotten eggs at me, and I'm going to fall. But
This is all the proof, kind of the top of one in the last few years.
the algorithm I've got, I've back tested over 130 years to make sure that they find the various tops. And the signal we got in June is the 21st time it's happened, the signal, and the other 20 times, every single one there was a significant downturn of at least 12%. So I back tested the data to make sure that it's right.
It's only backtesting, not.
What answer that way? Which guy was going to go?
But you can come to me in the break and ask me again.
And what about the VIX index? Would you compare the two?
Yeah, the VIX I include, because it's an inverse, I include the VIX in some of my models, yes.
Okay, that's, thank you very much.